Hey, what's up? I'm Russ. We have two daughters, ages 14 and 13, and we just started saving for their weddings right now. You may think that sounds a little bit crazy, but I'm going to show you and hopefully convince you that if you have small children or if you are in your early 20s and you think you're going to get married someday, why it's probably in your best interest to start socking away that money because it's going to make a really big difference years on down the line. So according to the US Census Bureau, the average age of a first marriage is 28.6 years old for women and 30 years old for men. So in 2005, when I got married, I was 27 and my wife was 28. So we really weren't that far off from those averages. But currently right now in 2021, according to nerdwallet.com, the average cost of a wedding in the United States of America is $28,000. Now, it's all going to depend on the couple. Yeah, some are going to be the bridezillas and want to go really extravagant and lavish, and other people are going to want to be like I was and want things to be as frugal as possible. Now, my father-in-law did pay for the wedding, so I don't know to this day what it cost, but I suspect it wasn't anything obnoxious or crazy. We rented out a single banquet room in a hotel, the ballroom, where we had our ceremony and then the wedding right afterward. We had White Castle catered in at the end. But check it out, I had no tuxedos. I wore a bowling shirt, as did my groomsmen. I wore flame boots, and we even had an Elvis impersonator. So we really want to pay it forward to our daughters who are 13 and 14. So we've got a ways off. If they hit those averages, I've got about 15 more years for the savings to take effect. But that's okay, because I'm going to be ahead of the game. But I will add that you really probably shouldn't start doing this, in my opinion, until you are out of debt. You don't have any of those high consumer credit card debt. You don't have those student loans or car loans. And you really want to focus on getting out of debt and taking care of yourself before you start saving for those kiddos' weddings. So this is so important because check it out. Balance.com notes that the average 100-year return of the stock market is about 10%. We're going to run a few hypothetical scenarios on investor.gov using their compound interest calculator. The link in the description is below. Feel free to plug in a few numbers and play around with that if you would like. But we're going to look at mine and a really easy hypothetical. Currently, we are putting $100 a month. We started with $100 base, and we're going to do that, think about, for 15 years, and we're going to have that 10% return every year. Go conservative with it and just assume about a 5% average return, see what that would look like. So we have the $100 initial investment at $100 a month, and again, we're going to use that conservative 5% interest rate. We get $26,102 compounded annually after 15 years. But if we use 10%, that number would jump up to $38,500. And say you had a $25 initial investment, adding $25 a month at 5% would leave you with about $6,500 after 15 years. And if we use that 10% interest rate, that would jump to about $9,600, $96,500. So you're good into almost a third of that $28,000 average wedding as it is right now. Who knows what it's going to be in the future, but the point of this is you will have something cash money to put toward those weddings. Now, the way I decided to do this and make it easy, because I'm busy and I have the bridge portfolio behind me, which you can head on over to dapperdividends.com, click on my portfolio, and you can look at what we've got going on there. We're going to do this the easy and simple way by investing in two ETFs. Those are exchange traded funds, and all that an exchange traded fund is a basket, a grouping of stocks. So the first one is the Schwab US Dividend Equity ETF, ticker SCHD. Couple of really quick points here is they have an expense ratio of 0.06%. That means on every $1,000, you're going to pay 60 cents in fees to Schwab every year, super stupidly low. You're buying immediately into 103 stocks, which is fantastic. You get paid money quarterly. That's the distribution, kind of like a dividend. The 10-year annualized return, check that out, we're just over 15%. And since inception in 2011, it has also returned about 15.64%. It's mostly comprised of large value companies. These are the big blue chip companies, which is where you want to be. They are less risky than many other stocks that are out there. There's that 5-year earnings growth of 9.75%, so almost keeping in line with our 10%, but we're also getting dividends. And the top 10 holdings that are in there are Pfizer, Broadcom, Cisco Systems, Coca-Cola, Amgen, Merck, PepsiCo, one of my favorites, Verizon, International Business Machines, also known as IBM, and the Home Depot. And then looking at those distributions, the most recent one in December of 2021 was for almost 62 cents a share. Before that, we had almost 59 cents. Before that, almost 54. And then in March was about 50 cents. So we see as the year goes on, that does increase and get a little bit bigger. I'll put a link to that Schwab fact sheet where I got that information from in the description below if you want to check it out. So really cool. We're getting exposure to a bunch of dividend stocks, and they're going to pay dividends to the ETF. That's going to pay those in the form of a distribution to us. Pretty much the same thing, super low expense ratio. Now you could have just ended it there and I would have been just fine with that. But as an investor and somebody that likes to utilize covered calls to generate even extra income, we went with the DIVO, which is Amplify, their ETF, the Enhanced Dividend Income ETF. Basically, this is comprised of high-quality dividend-oriented stocks, which we love, and they use covered calls on those stocks. Again, the ticker is DIVO. You must whip it. Da-na-na-na-na. Whip it. Whip it good. 28 holdings, a 5-star Morningstar rating, and that expense ratio is a little bit higher. It is 0.55%. So that means over the course of a year, you would pay about $5.50 on every $1,000. Now, if you don't understand covered calls, do not worry. That is something that a little bit of more advanced investors use, and I love to use covered calls. You receive these distributions monthly at about 4.80% as opposed to SCHD, which was quarterly. Started out right around $25 when it launched in 2016, had that hiccup during the pandemic sell-off, and there we are now. So it's been going nice up and to the right. And why? Because it is comprised of mostly big blue chip companies like United Health, Chevron, Apple, Visa, McDonald's, Microsoft, My Procter & Gamble, and the Home Depot as well. And I love right at the top that they're selecting companies that are dividend growers, companies that are high quality and large cap, and they historically grow their dividend and their earnings. And if we do look at DIVO, distributions, we do see that in 2021, at the beginning of the year, it's around 15, almost 16 cents, and then it was around 14 cents at the end of the year. So it may change. This is a little bit more volatile. The two payments so far this year were at 14.5 cents roughly. But overall, I do think it is relatively safe, and it's going to provide some really nice income over the years. Now, this is just my strategy. I feel comfortable using these two ETFs to someday pay for our daughter's weddings. Why? Well, for me, it's going to be much easier to not become attached. I have a very bad habit of marrying all the stocks that I buy. So oddly enough, I don't want to hold any individual stocks for this, because if I were to buy PepsiCo, I don't want to sell those shares of PepsiCo. But if PepsiCo is in an ETF, it's much less personal, and it will be easier for me to liquidate those shares to raise cash to pay for the kiddos' weddings. And one last thing, at least on Schwab, I cannot buy fractional shares of these ETFs. So what I'm doing is I'm just going to let the dividends collect, and then every month I will buy more shares of these stocks as much as I can. So we're going to just do that over and over for the next however long it takes them to pick the one that they love. And hey, if they never do, then we can give that money to them for a down payment on a house or something else. There's so many uses. It's just going to be such a benefit to have that cash waiting and ready to pay for a worthwhile life experience. And once again, the links for both of those ETFs where you saw me look at will be in the description below. I'd love to know if you're saving for your wedding or your kids' weddings, how you're doing it. Please feel free to share that in the comments below, because you know where the comments go. Speaking of call options, covered call options, which is what Devo utilizes. Da-na-na-na-na. You must whip it good. Look at this little box next to my head. I was joined by Jeremy from Dividend Stockpile, who is very, very knowledgeable on covered calls, and he dropped some of his wisdom. So if you'd like to learn more about that, click that video, and we will talk to you there.